Welcome back. Now, this week is crucial for the Monetary Policy Committee as investors eye the inflation report, which could play a role in future MPC decisions. Joining me now to discuss these expectations and what they could mean for the economy moving forward is RMB's Chief Economist, Isaah Mhlanga. Isaah, thanks so much for joining us today. So, ahead of the rates decision, we have inflation numbers being released tomorrow. If we're being honest here, consumer prices have proven to be sticky this year, but we have seen somewhat of an ease. Let's start there. What are you expecting on the inflation front, considering that petrol prices have been declining and we've been seeing an ease in food prices?
Look, the inflation, figure, we expect it to be flat. But I think if you look at the central bank's decision-making process, they consider the average inflation for the year. And in that respect, we expect it to be around 5% for this year, moderating to 4.6% and 4.5% in the next 2 years. So if you just look at that path, it would suggest that the midpoint of the Reserve Bank's target of 4.5% is not going to be met this year, which is why we don't expect a rate cut this week, but we do expect a rate cut beginning in November with just 25 basis points for this year. So overall, what we expect is, a very marginal reduction in the repo rate this year, followed by another very gradual. And this stems from several factors. One is the U.S. Federal Reserve that has not yet reduced rates, which we expect to begin in September. That is potentially constrained, so the SARB is unlikely to move before the Fed move. Secondly, we have risks of El Nino and the implication for food price inflation that we think is still going to come through. That is a constraint on the SARB as far as that it pushes headline inflation higher. And then thirdly, which on a positive side, the compression of the political risks premium following the conclusion of election, the inaction of the government of national unity, that is going to add positively to positive factors that should persuade the SARB to start considering cutting interest rate. But that in itself is not enough. We still need to see overall broad inflation moderating towards the midpoint of the SARB, which is 4.5%. And inflation average of 5% this year is still much higher, even though it's within the target of 3 to 6%.
And I want to, zoom in on those positive factors. As you've mentioned, we have some stability on the political front with the GNU coming together. We've also seen the Rand strengthening. Surely, Isaah, this does give, the SARB some breathing room.
It does. The political risk premium is important from the cost of debt perspective, which affects the risk premium that is in the SARB's models, but also from a currency perspective, we still expect the currency to do well. So we have an average of about, 1839, or you could say 1840 for this year, still appreciating to about 1754 in 2025. That should help inflation, particularly given that we have a significant component of imported products or imported inflation. So that should help us. But I think given where the SARB wants inflation to be at 4.5%, we are still far off for all these factors to drive inflation to the midpoint, at least not this year. Next year, that's where we see inflation moving closer to the midpoint, which is why we're expecting the SARB to begin rate reductions only in November, not in July, not in September, but in November, in preparation for inflation moderating closer to the midpoint in 2025.
When we started this conversation, you mentioned how the Fed influences the some of the decisions that the SARB makes. Just how much of that influence, or rather, just how important, is that influence, considering what Kganyago had said before, that the SARB doesn't necessarily follow the Fed, but rather watches those moves?
Indeed, there is no evidence to suggest that the SARB follows the Fed on a one-to-one basis, but what the Fed does influences global financial conditions, not just for South Africa, but across many central banks in the world. So to that extent, it influences the direction of the dollar, which also influences how emerging market currencies respond. So given our expectations of a later cut by the Fed, mind you, in Q4 of 2023, we were expecting, or market were expecting, close to 6 rate reductions by the US Fed. We haven't got any so far, and there's only one that's expected in September, and perhaps another one expected before year end. So from 6 to only 2 rate reductions, it changes the whole reaction function of markets as far as global interest rates are concerned. And the SARB had to take that into account because it influences how the rand performs, which influences inflation expectations. And if we are talking about inflation expectations, they are still far higher compared to the midpoint of the what the SARB wants to target, which means the SARB would want to see those inflation expectations moving closer to the midpoint before they start to cut interest rates.
You mentioned El Nino as, a risk to inflation. What about that oil price? And, the tensions in the Middle East have somewhat quietened down, but does that risk, still play when it comes to, inflation expectations?
Look, oil prices have been well contained so far. To your point, we haven't seen an escalation in terms of the Middle East conflict, and also energy markets in general, inclusive of oil, have also not resulted in an increase in prices. That is positive. But I think coupled with that is the currency that has improved, that we continue to expect to improve. In rand terms, it means we expect the cost of fuel to decline over the next year or so, which should add positively to our inflation expectation going forward. Hence, our take that perhaps towards the end of the year we should start to see the SARB that's going to start to reduce interest rates, and even more into 2025. But we are not seeing the benefit of the stable oil prices and the currency yet. We're only going to see that towards the end of the year into 2025.
So we're crossing fingers and toes that that rate cut really does come through before the end of the year. Isaah, thank you so much for your time and those insights. That was Chief Economist at RMB, Isaah Mhlanga.